Guess we're recording. Well, check this out. When you look at a company's stock profile, you see the price, the volume, and a number called shares outstanding. For many, that's where the analysis ends. But if you want to truly understand the engine behind a stock's price movement and your actual power as a shareholder, you have to look at, well, you got to go deeper. You have to understand the float, the buybacks, and the cancellations. These aren't just accounting terms, these are the levers that management pulls to either create massive wealth for you or, in some cases, to mask a business that is struggling. Hey there, my name is Anthony and welcome to Growing Your Wealth. Today, we're going to break down the supply and demand of the stock market. We're going to look at shares outstanding versus the float and the controversial world of share buybacks. So, let's start with the big picture. What are shares outstanding? Well, shares outstanding represent the total number of shares a company has issued that are currently held by all stockholders. This is just imagine a pizza, okay? This is the total pizza. It includes everything. You got the shares held by retail investors like you and I. You have the massive blocks held by institutional banks and the restricted shares held by company insiders, executives, and employees. This number is basically the denominator for almost every important financial ratio like earnings per share, etc. If the shares outstanding is 1 million and the company makes $1 million, the math is simple, $1 profit for every one share. But there is a subset of this matter that is actually more important for daily price movement, and that's what we call the share float. The float represents the number of shares that are actually available for public trading. To find the float, you take the shares outstanding and subtract the restricted shares. Those are the ones that are held by insiders or founders that aren't actually able to be sold yet. Think of it like a housing development. The shares outstanding is every house in the neighborhood. But if the developer owns 60% of the houses and isn't allowed to sell them for 5 years, those houses aren't on the market. The float is only the 40% of the houses that people can actually buy and sell today. So you're probably going to ask, why does the float matter? Well, it matters because of volatility. If a company has a massive number of shares outstanding but a very small float, it means there is limited supply. When news breaks, even a small amount of buying pressure can send the stock price skyrocketing because there aren't enough slices of pizza available to go around. Conversely, a small float can lead to violent crashes. Understanding the gap between the outstanding and the float tells you how much insider skin is actually in the game. Then this is how we determine how liquid the stock truly is. Now let's talk about the most powerful tool a CEO has to change these numbers. This is what we call the share buyback. A share buyback or repurchase is exactly what it sounds like. The company takes its extra cash, money it didn't spend on research, marketing, or new buildings, and goes into the open market to buy its own shares back from investors. When a company buys back its shares, two things can happen. Usually, they cancel or retire those shares. This is the process of permanently removing them from existence. They aren't just sitting in a vault. They are actually deleted from the total share count. So you're probably going to ask, what is the purpose of this? Well, it's basically the opposite of dilution. When a company issues new shares to raise money, your slice of the pizza gets smaller. And when a company buys back and cancels the shares, your slice gets bigger without you even having to spend a single penny. You don't have to buy anything. It just gets bigger. Thank you, companies. Let's look at the nuances and the benefits. The primary benefit is to boost earnings per share, or EPS. Remember our math, $1 million in profit divided by 1 million shares equals $1 per share. But if the company uses cash to buy back and cancel 200,000 shares, that same $1 million is now divided by only 800,000 shares. Suddenly, your EPS jumps from $1 to $1.25. The business didn't actually grow its profit, but on paper, your share of that profit just increased by 25%. This is a massive benefit for long-term shareholders. It signals that management believes the stock is undervalued. It's a vote of confidence where the company is literally betting on itself. Furthermore, buybacks are often more tax efficient than dividends. When you get a dividend, you usually owe taxes on that cash immediately, unless it's in a non-taxable account like a Roth IRA. But with a buyback, the value of your share goes up. But you don't pay taxes until you actually decide to sell. Be mindful though, taxes only apply to taxable brokerage accounts. If you don't know which accounts are right for you, I made a video right there for you. Okay, so I wouldn't be doing this video justice unless we have to look at the negatives, because buybacks, they're not always a net positive. The biggest negative is the opportunity cost. Money spent on buybacks is money not spent on innovation. If a tech company spends $10 billion buying back its own stock instead of developing the next generation of technology, they might look great this year, but they could be obsolete in 5 years. Critics call this financial engineering. Using accounting tricks to make the stock look healthy while the underlying business is actually stagnant, yeah, it's not a good look, and it's definitely not good business. Well, there is also the risk to poor timing. Just like retail investors, companies often get caught up in the hype. Many companies buy back massive amounts of stock when the price is at an all-time high, only to see the market crash a year later. Let me use a real-world example. During the inflationary period of 2022, a company by the name of Restoration Hardware, or ticker symbol RH, initiated a $2 billion buyback. If you know anything about this business, they are in the luxury furniture business. With the Fed raising interest rates historically fast, nobody was out there actually buying new homes, let alone paying a premium for furniture. While their stock price ranged from $500 to $250 a share, they took on debt to buy back those shares. Instead of utilizing the cash they had to strengthen the business, they believed their stock was undervalued without assessing the true macroeconomic headwinds they were about to face. Today, their stock trades around, $150 a share, it just depends, but it's not where it used to be. And the way I look at it, this is a total waste of company cash. They bought high and effectively burned that money. Okay, so the most cynical negative may be masking dilution. Some companies give their executive huge amounts of stock-based compensation. To prevent the share count from rising and upsetting investors, they use the company's cash to buy back shares just to cancel out the new ones they gave to the bosses. In this case, the share count doesn't actually go down. The company is just spending its profit to keep the executives' ownership high at your expense. That's a no-go. We gotta look at that. So how do you evaluate this as a steward of your wealth? Well, you have to look at the net change and shares outstanding over time. If a company announces a $1 billion buyback, don't just celebrate, look at the financial statement to determine share count. Did the share count actually drop? If it stayed the same, they were just offsetting dilution. The gold standard of buybacks is a company that has a stable, growing business, plenty of cash, and a share count that is consistently drifting downward year after year. That is a company that is systematically making your ownership more valuable. Now, I know I've used this verse before, but it's so beautifully used in the world of finance. Proverbs 13:11 says, "Dishonest money dwindles away, but whoever gathers money little by little makes it grow." Share buybacks, when done correctly, they're a way of gathering little by little. They are slow, methodical way to increase the value of your holdings without taking on extra risk of new capital. But you must be diligent. You must ask, is the company buying back shares because they are truly cheap, or are they just trying to hit a quarterly bonus target? Understanding the difference between the total shares outstanding and the tradable float, and knowing the why behind the buyback, separates the gamblers from the investors. It allows you to see true supply and demand of the business that you own. Okay, so that's it. In the next video, I'm going to run through some ratios with you. It may be boring, but understanding these ratios will make you a better investor going forward. Okay, so hey, I want to hear from you. Let me know. Get in the comments. Did it help you? Do you prefer a company that pays a steady dividend, or a company that's aggressively buying back its own shares? Which one makes you feel like more of a true owner? Okay, well, click right here. YouTube thinks this video is a good fit for you. And until the next video, stay diligent, keep learning, and remember that your stewardship matters. Happy investing, and may God truly bless each and every one of you.